better to have a wonderful company at a fair and reasonable price rather than a super cheap stock where the price is super low, but the company is so-so. So our emphasis is on the company, but the price is not to be neglected. We can't pay too much. We will always calculate our return from the price we paid until the price we sell the stock. So it has to be fair priced, but the emphasis is on the company. You could visualize it this way. So we have the company, and that is what we're interested in. The stock, if you just think about it, that's just a piece of paper that represents the ownership of that company. But this stock, it is due to a lot of influences. It could be speculation, and that drives the stock prices a lot these times. There's forums, podcasts, blogs, analysts, all types of influence that makes the stock price go up and down. And then you have the economy as whole. In March this year, the stock market fell dramatically, even though some companies weren't affected. Most of the companies fell at least 30% because that's the stock market reaction to coronavirus. But most of the companies, they weren't hit by the virus, they were actually benefited from the virus. But nevertheless, they took a hit because the economy as a whole looked to be in bad shape. It was the same in the financial crash, and it's going to be the same in the future. So even though it doesn't affect the company, it might even affect the company positively, nevertheless, it could affect the stock price negatively. And buyouts, if you're going to buy another company, you usually have to pay a premium, etc., etc. So a lot of things influence the stock price. And that's why we put those aside and put emphasis on the company, because that's where the value is. That's what we want to have as an investor. But in order to get the company, we have to go through the stock and buy that stock. So we can't neglect it. We have to pay fair price, but it doesn't have to pay. We doesn't necessarily have to pay cheap price. It needs to be fair if the company is wonderful. So fundamental analysis in a nutshell, you derive from historical data a calculated estimate of future performance. So that's basically what we're trying to do. Look at the history, how has it performed, and try to guess into the future. We have to do this because we invest for the future. So we have to make a calculated guess. But nevertheless, it's usually history or peers that we look in order to make that estimate of the future. So it's usually numbers. A fundamental analysis is a lot of numbers game. So there's the balance sheet, the income statement, the cash flow statement, but there's also a lot of room for soft values, like the brand. It's difficult to put a number on the value of the brand, but you do recognize the Apple logo, and you do recognize the H&M red colored letters. So the brand has some value, even though you can't put a number on it. And that could sometimes be the value of the company. And then you have the management. Is the people in the organization skilled enough to put this organization forward? Who's the owner? Do you have one big owner? That could be some risk because it's either going to be good or bad owners and the decisions they have. But there can also be some great risk if you have a too diversified owner base. If you have 10 semi-big owners, then there's not going to be all too much, this is the way we're going to do it. There's going to be a lot of negotiation in between the owners. And that could hinder the evolvement of the company. And then what's the moat? That probably is the most important one. The moat around the castle. The company is the castle, and the moat is what protects it from the competitors. It could be pricing game, it could be network effect, it could be a lot of things. But you have to figure out what makes this company special and what makes it not so easy for competitors to enter the game. And then obviously we have to compare. There's a lot of wonderful companies out there. That is actually the case. There's obviously more bad companies than wonderful, but there is a lot of wonderful companies when you look at it. But the sport is to buy the wonderful companies at fair price. So it's not only to go out there and buy the wonderful companies and fill up your portfolio. You have to pay reasonable price. And that's the tricky part. So it's a duality here. So you can't only pay cheap price and get a semi-good company. It has to be a wonderful company, but it can't also be at a too high of a price. And that's the sweet spot. When you find those pearls that hasn't yet gone up in too much of value or price, and then you could buy them at a fair and reasonable price. So that's fundamental analysis. That's one of the big schools. There's another school of investing in stocks and analyzing stocks, and that's the technical part. And the technical school, that goes from historical market data in order to calculate a estimate for the future stock performance. So in the technical analysis, you usually put everything that has to do with the company aside. You only focus on the stock. How's the price performing? How's the momentum? Is there a lot of buyers right now and not so many sellers? You look more to statistical signals, data, and so forth. We're not going to put that much emphasis on technical analysis in this session. You could use these two in combination. I'd say that the fundamental analysis, that's going to be the most valuable analysis method for the long run, because the stock, it has only one job, and that's to mirror the value of the company. And in the long run, it's pretty good at doing that. But in the short run, there's a lot of stock price fluctuation. And that's where the technical analysis comes in. And you usually don't get new information from the company in between the quarterly reports. So, and we all know that the stock price, it never stays still in between the quarterly reports. So obviously there could be some reason in trying to analyze how the behavior of the stock and the stock market is doing in the short run. You could use it to time your buying and selling, or you could just use that as your trading tool. But nevertheless, we're going to focus on the fundamental analysis. And I usually break down the fundamental analysis in two subgroups, sort of different types of analyzing a stock. The most popular one, I'd say, is the relative valuation. And this is where you put multiples on the stock and you compare it to your peers. So how much do you pay for this year's profit, this year's cash flow, this year's or next year's dividend, and compare that to similar companies within that sector. That's the same thing we do when we buy a place to live, the home or the apartment. Why is the apartment priced at the price you're paying it? Well, it's simply due to that's what other apartments in that area is priced at. So the relative valuation, it's just a pricing game. You look at what other types of investments are priced at this moment, and hopefully in the future, and try to figure out what the how cheap could you buy this, and how much value is in this company. And you do it from a historical and today and a future estimate, obviously. And then we have the intrinsic valuation. That is what most analysts would say the more correct way of investing or analyzing stocks. And that is what separates stocks from other types of assets, such as gold or bitcoins, which doesn't produce any cash flows. So the intrinsic valuation, it lies in the cash flow. So how much is the future cash flows that this company could produce worth today? So we discount all the future cash flows back to present value. And you could use these two in combinations as well. You could try to figure out the future cash flows and try to estimate what might, in that 5-10 year time, be the total enterprise value of the company. And then what would the multiple be at that stage? So you could use these in combinations as well. And we're going to go through them a bit. It's obviously going to be more of introductory since we only have 1 hour. But starting off with the relative valuation. So we use price multiples. The most popular one is the PE ratio, and that is the price of the stock divided by the earnings per share. Or you could take the full market value of the company divided by the total profit of the company. It's going to be the same number, but that's the PE ratio. I'd say there is a better one, and that's the EV/EBIT ratio, where you look at the enterprise value instead of the market cap. And the enterprise value, that is the market cap plus net debt. So if the company has a lot of cash, or if it has a lot of debt, that's going to affect the total value of the company, the EV, the enterprise. And then EBIT, that is a bit higher up in the income statement. So it's not the lowest level, the profit. It's what we in Sweden call rörelseresultat. It's the profit after operation expenses. Why do we compare this? Well, why do we use this? Because it's more comparable in between companies, and also in some cases in between sectors. It's not 100% comparable, but the income statement, you as a company have a lot of flexibility in how much you would like to show as profit at the end. And looking a bit higher up could usually give a better result. So that's the EV/EBIT. And if we look at H&M, for example, that was at the end of last year. So the PE ratio was a bit higher than the EV/EBIT. And that is due to H&M being a kind of low debt company. So if you have a lot of debt, then it's going to look worse from an EV/EBIT perspective. And when you don't have as much debt, it actually looks cheaper from a EV/EBIT perspective. You can't obviously base a company or a stock only due to this multiple, but it gives you a sort of baseline understanding of how much are you paying for the profitability today. Or you could look at the next year, what the analysts thinks about the profit or the EBIT, and try to figure out how much you're paying for that today. But this is a good starting point, and it is the most popular pricing tool, just simply because it's the profit, and that's like the main goal of a company, to produce profit and try to figure out how much you pay for that today. But we need, and it's also a bit smoother. So this is Telia over the last 10 years. So the PE ratio, it has been quite high from time to time, and then quite low. So look at 2017. It looks much cheaper than compared to 2016 from a PE perspective. But that is simply due to Telia selling off their foreign affairs. I'm losing the name now, but if it was Uzbekistan or any other country where they sold off their dotterbolag. I'm losing the English word, but I think you get the picture. But if you look at it from an EV/EBIT perspective, it looks much smoother, and it doesn't actually looks cheaper in 2017, and neither did it in 2019 compared to the year before. So EV/EBIT usually a bit smoother. Do we have any questions so far? I'm just talking. So let me know if you have any questions.
We do have like maybe 2 or 3 in the Mentimeter so far, okay, but we can read that later on, so you can finish your presentation now.
Okay, great. So the EV/EBIT, that is a profit perspective, but we need to find out the profitability. So not only how much we pay for the profit today, but how much more profit could they produce in the future, and that is the profitability multiples. And the most popular ones, let's see if we could move ahead. It's either return on equity or return on asset. You could also use return on invested capital. These 3 multiples, they have the same basic idea, that you're trying to figure out how much profit is the company producing with its assets in place. So either you look at from the return of equity perspective, where you're only just focusing on the shareholders' money within the company. That is the equity. It's either the money the shareholders have put in or earlier year's profit that has been accumulated. That is also the equity. So you look at how much profit is produced in comparison to the equity. And if it isn't that much, then, well, it's probably a better idea for the company to pay out the money, the profit in dividend, instead of accumulating the equity within the firm. So the return on equity, it is one simple measurement that gives you a good understanding of how profitable, how good the company is to create profit with the shareholders' money. Obviously, the higher the number, the better. But this is not the full picture. So a company could borrow a lot of money in order to create more profit, and the return on equity would look fairly good. But if you look at it from the total balance sheet perspective, the return on asset, it might not look as good if the company has borrowed a lot of money. So it could be a good idea to use them both in combination, just to make sure that if the company is highly in debt, the return on asset is usually a bit lower. The most from most industry companies, it's the return on invested capital that is the most interesting one, and that is the working capital plus fixed asset minus cash. So it's a bit more tricky to figure out. It's basically the ongoing capital, the capital that is used daily to produce more profits. If you look at a balance sheet, there's not only capital that has been deployed to work for the company, so to speak. You have some immaterial company, immaterial values, you have some pensions, and you have a lot of other things. So you're trying to figure out what are assets in place in order to trying to produce profits. And here are some examples. So NetEnt and Evolution Gaming, now they're both the same company since Evolution bought them, but NetEnt, high return on equity but low return on asset due to its higher level of debt in comparison to Evolution Gaming. But nevertheless, they're both very, very profitable companies. And if you only look at return on equity, it could be misguiding as well. Look at Swedish Match. It has a negative return on equity. And Swedish Match is definitely profitable. It's the Swedish snus company, but they are one of a kind and have a negative equity. And that is just simply due to history and a lot of write-downs. So the return on equity, it looks negative, but when they in fact are actually quite profitable. And EQT, it's not that they are both the same company, but if you look at it, my point here is if you only look at return on equity, it could sometimes be misguiding. The return on asset is more, or them both in combination is probably the more accurate way. And if you look at industry companies, it's the return on invested capital that is probably the most accurate one. You could try to figure out the return on invested capital on other companies as well, but it might not always be as easy. Take Evolution Gaming, for example. It's not as capital heavy industry they're in. A Atlas Copco or Boliden, they have to hold a lot of capital in order to produce profit. They have to have their machines, their inventories to create the profits. Evolution Gaming, it's a more digitalized company. They don't need to hold or they don't need to bind that much cash. So it's usually good with the return on equity or the return on asset. Nevertheless, you need to figure out how good of a profitability is this company. How good are they at producing more profits? And sometimes when you value smaller companies, there is no profit to speak of. Then you have to value the revenue. And it's the same with the PE ratio, but instead we have the PS ratio. So you take the stock price in comparison to the top line of the income statement, the total sales. And once again, I'd prefer the EVS multiple instead, just simply due to enterprise value being a more fair comparison of the value of the company. And this could be even more reasonable when you have a company that doesn't yet produce profit, just simply due to they might have a lot of borrowings that the bank might want their money back from, which could then create some trouble down the line. So the EVS is probably the better multiple from a revenue perspective. And also, it's the same here. So the PE ratio, the lower the better. The PS ratio or the EVS ratio, the lower the cheaper. But once again, it's also good to think twice before you buy the lowest multiple. It could be low for a reason. The stock market doesn't like this business model, or they haven't had a good track record historically, which makes the multiple quite low. So you have to understand if it's cheap or if it's just low expectations. The best part it would probably be if it's low expectation, but you think otherwise. You think that this company is going to turn around now and perform much better than they have done historically. Then you could buy it at fair or cheap price. But once again, you have to figure out if it's a wonderful company and never buy if it's not. And also it's different for different sectors. Some sectors, the more digital ones, they usually have way higher multiples. But you also have to remember they have also a higher growth rate. So it's not necessarily bad to pay EVS 10 instead of EVS 2 for a company if the growth is much higher for the first one. So if the company is growing either their sales or hopefully their profit in the end, paying a higher multiple could be worth it. So here you have some companies. So the Eniro, MQ, and Oscar Properties, they have really low multiples, but they have also performed really bad. And that is just simply that the stock market doesn't believe in their business model. While you have some, so these are more life science, medtech companies, they usually have way much higher multiples, but they have also performed. So it might be reasonable to pay a higher if you think the growth is going to be high. But nevertheless, if you pay a too high of a price, the expectation could also be quite high. And if it doesn't reach up to the stock market's expectations, that could sometimes mean a negative return nevertheless. So that's the relative valuation. There's several more multiples to choose in between from, but I'd say the most important one is to figure out what are you paying to get the income statement. So what are you paying for the profit? What are you paying for the sales? So the income statement shows us what the company has performed. How are they doing? But then you have to compare that to the balance sheet in order to get the picture of the profitability. Are they holding a lot of cash, which doesn't produce as much profit? Then probably it won't be able to grow as much. Charlie Munger used to say that the long-term growth rate of a stock can't oversee the profitability of the company. And I think there is something to that quote, i.e., if the return on equity is 10% and the stock price is increasing 15%, the stock price is increasing more than the profit of the company. And that could continue for a short while, but in the long run, the stock is usually pretty good at reflecting the value of the company. So it can't usually go on for too long that the stock price increases more than the profitability of the company. And like I said, there's a lot of other multiples as well. Do we have any questions now, or should we get into the intrinsic valuation? Crystal clear. That's awesome. So if you have any questions, just let me know. It's totally fine to ask questions. We could always jump backwards as well if there's on an earlier slide. But if not, let's move into the intrinsic valuation. So these might be new grounds for some of you. I think you're quite familiar with the multiple game, where you put different multiples in order to figure out if it's a reasonable price to pay. But the intrinsic valuation, that's probably where the real fundamental value of the company lies. And there is a part of the intrinsic valuation that we have to understand, and that is that the money is more worth today than tomorrow. So a dollar is worth more today than tomorrow. So the future cash flows that a company produces needs to be discounted back to the present value. And that is just simply because I want money today, preferably over tomorrow. And why do we have this preference? Well, it's for consume one. That is one aspect. People usually like to consume things today rather than tomorrow. Obviously, we can put off some consumption, but if you're hungry and you want food, you want that now. You can't say, "Oh, I'll eat next week instead." It doesn't work that way. So that's why we have the preference. People usually want to consume today. And then we have the inflation. So the purchasing power of our money is decreasing by time. And it's actually a goal for the central banks to decrease the value of the money. And that is just simply because money is just a tool. Money is supposed to be used. It's either supposed to be consumed today or invested for the future, so it could grow and you have a larger amount of money which you could consume. So the inflation makes the wheel spin faster. But nevertheless, it makes the purchasing power of our money decrease. And then also we have the risk. Money you have in your hand today, you know you have. It's more safe than a promise in the future, because the promise might not be delivered upon. So that's why we need to make sure we have the present value. And this is the calculation at hand. This is the heart of the intrinsic valuation. So you actually look at the cash flow in the future and you just divide that by the discount rate uh, uh, and the time period for that. Let's take an example. So let's say you buy an investment, a company that promise you $1,000 in 10 years time. And that's the cash flow. So it won't pay any dividend until 10 years. And then it will pay you 1,000. So how much is those $1,000 worth today? Well, if we use a 8% discount rate, those 1,000 in 10 years time is worth $463 today. If you look at it from the other perspective, if you pay $463 and receive 1,000 in 10 years time, that is equal to a yearly return of 8%. So that's the key here. So the discount rate, that is what we expect this investment to yield for us, what we expect it to give us back in return. If you were to instead pay only $300 for these 1,000, that would mean a yearly return of around 13%. So obviously, the cheaper you pay, the higher the future cash flow, the better the return. But that's the same that we know. But this is good to have in mind. So the future cash flow and the discount rate, what you expect it to give in return. And this is just a simple discounted cash flow model. You could obviously make it much more advanced, but we're going to walk through a simple one so you have an understanding of a discounted cash flow model. Because as an investor, you will probably encounter a lot of these during your career. So we have a company here and we estimate out the cash flow for the upcoming 10 years. And I just start off with, in my example, I use 10 years. probably it's better to do an analysis in the shorter time period. So you don't have to make it longer than necessary. But if you can make it longer, it's probably going to yield a more accurate value. But 10 years is a long time. We might not know what's going to happen in 10 years. If you're going to do a discounted cash flow model of H&M, well, it's more reasonable that you have an understanding of 10 years. But if you're going to do a discounted cash flow model of Facebook, it is not as reasonable. Facebook, a much younger company in a growth sector, which didn't exist 30 years before. But clothings, we've always had them on ourselves. So probably H&M or any clothing company will exist in the future. So you have to bear in mind what you're estimating. Is it reasonable or not? But nevertheless, so here we have 10 years, and I've estimated a growth rate of 8%. So the cash flow today is 1,000, and it's just growing with 8% linearly every year. And how did I come up with this figure? So, well, a tip is the growth rate. It can't, so I mean, growth never comes free, and usually doesn't come cheap either. So in order for a company to grow, it has to invest. It has to buy something that produces the product or service that they're selling, or they have to invest in the sales force or in something that is creating profit. So the growth rate is usually the reinvestments. So how much is left from this year's profit after dividend and interest payments and such? So what's the reinvestment? And what's the return on that investment? And you could look at the return on equity for a proxy, but it's obviously better if you could understand what is the company investing in and what return do they usually get on those investments. So in my case here, I'd calculated that the company can reinvest 30% of the profit after dividend and interest payments. And it's usually a return on 26.5%. That gives me a growth number of 8%. So that's just my case here. So we have 10 years and the sum value of all those. But these are the future cash flows. We know that we have to get the today value of those cash flows. So then we add on a discount rate. And I use 7.6%. Why did I use that? Well, here's the tricky part. You could use whatever discount rate you would like to have. I mean, obviously, everybody would like to have 20% return every year in their portfolio. So then you could put in 20% in discount rate. But that means your future cash flows is going to look not so good. That means that the value of those future cash flows is going to be quite small. So it's not going to look any favorable. So obviously, the higher discount rate, the harder it is to find a reasonable price. And then if you look at it from the other perspective, what if you pick a low discount rate? Let's say you only use 3% instead. Well, then those future cash flows is going to look quite handsome. And that's going to make the value of your company rise. So the trick here is to pick a reasonable discount rate. And actually, the simplest way is just to see what the market is using right now. So you have the Swedish firm PwC. They usually ask every year a lot of portfolio managers, fund managers, what are they using as discount rate? And then they present the average. And that is the average which they last presented this summer. So I think it was July or August that their yearly review is published. And so that's why I use that number. But you could obviously use your own number, but it's probably a good idea to use what the market's using, because then you get what the market is valuing your company at. So here we have the year one, those 1,080 cash flows, it's only worth 1,004 when you've discounted the value back to present value. So now we discounted all those. In year 10, those 2,159 in cash flow is only worth 1,038 when you've discounted them back. If I were to use 8%, you see that the growth and discount would equal out. So these are the upcoming 10 years. Then in valuation, intrinsic valuation, what we usually do is we make the company mature at that time, and we let it grow into eternity. And I know that sounds like a fiction novel, but nevertheless, it's just to tie up loose ends. So in this stage, we usually see the company as a mature company where it would grow at a perpetuity rate. And that means a slow growth rate into the future. And that's just simply to tie up loose ends. You could also liquidate the company at this stage, but that's usually not the case. And if it's usually not the case that you liquidate it or that the company will grow into eternity, but nevertheless, we need something to tie up the loose ends. So that's why we use the mature phase. So the perpetuity growth rate, this isn't all too important, but you can't have it too high. That's the basic rule. So the company can't grow higher or at a higher rate than the economy as whole, because then after an eternity, then this company would be bigger than its market, and that's not physically possible. I know eternity might not even be physically possible either, but play along with me. So it's usually a perpetuity growth rate of 2% or 3%. That's more reasonable. The economy as a whole usually grows, depends on if you look at it from the global or if you look at it from the Swedish economy, that the Swedish one grows at around 2.5%, 3%, sort of. So I put 3% here. And you see the terminal value, that is just simply the same calculation, but you take the discount rate minus the perpetuity growth rate. So we have the sum value of the 10 years, and then we have the terminal value. And that is the year 10, and then the discount rate minus the perpetuity growth rate. If you add those two up, then you have the total value. And the total value is 34,445. And this is million USD, so it's 34.5 billion USD. That is the value of this company. If you just look at it, what we've just done is that looking at the future cash flows that this company we think can produce. And that is the value of the company. The company's sole mission is to produce cash flows. And now we have a number for those cash flows. Next step is to see if it's fair priced. And then usually we have a margin of safety, and that's just to be sure that we don't invest in too optimistic numbers. So even though we might arrive at 34.5 billion, it's usually a good idea to just cut off some of it. So in this example, I used 10% margin of safety, which means that I'll only put in 31 billion in value, because then I might be positively surprised. But I would not like to have too optimistic numbers and invest with that reasoning, and the company is not reaching that target. So that's why we usually make a margin of safety. This could be 10%, 20%, some even consider 30%. I think that might be a bit too hefty. That makes it difficult to find valuable companies. But nevertheless, I think you should use some margin of safety. If you have a higher discount rate, that is also sort of a margin of safety, because that means that the future cash flows won't be valued as much. So it serves as sort of the same purpose. But have that in mind, that you someplace have some margin of safety. So next step is to look at the price of the company. So let's say in this example, we have 100 million shares and the price is 100. That makes it a market value of 10 billion. But we also have some debt in this company, which makes the enterprise value 15 billion. So that is the price for the company, and the future value it can produce is valued at 31 billion. So the price is lower than the value. In this example, we would have a good buy. You would have a 48% return if the enterprise value would to reach sort of the future value of those cash flows, or the present value of those future cash flows. So we're buying at a cheaper price than the value this company can produce. So obviously this is just an example, but I hope it gives you the basic understanding of a discounted cash flow. So what's the future cash flows? Discount them back to present value, slice off some margin of safety, and then compare that to what's the price today for the company. Obviously, you don't have to pay, you don't have to buy the full company, but compare the firm's total cash flows with the enterprise value of the total company. So that's a discounted cash flow model. And what type of cash flow? That's usually a question I get. So I'd say it's not necessarily the profit you should put in here. So once again, like we said earlier, in the income statement, the company, they can sort of manipulate how much profit they want to show on the last column in the income statement. You know, they can do some deductibles and things like that. That's probably the most accurate one is the either free cash flow. You look at how much cash flow is left after operating expenses and investments. Or you could use the dividend as the cash flow. Then you have the dividend discount model, which is also a popular way of discounting future dividends. But nevertheless, you should pick a cash flow. So it's usually free cash flow or dividend. I'd say those are most often used. So finishing off, do we have any questions on the intrinsic value part? Nope. We're good. Great. So just finishing off a bit on what valuation isn't. So we talked about what valuation is, but now we're also going to go through some of the don'ts in valuation. So first off, valuation is not an objective way of viewing stocks. Obviously, that's what we think. That's why we use those advanced discounted cash flow models or price multiples to trying to figure out what's the value of this company. But know that we are all humans and we all have our biases. And when you look at a company, even before you do your analysis of that company, you are biased. Just simply why you picked that stock out of the 1,000 publicly traded on the stock market in Sweden makes that a biased choice. So understand it. There's nothing wrong with being biased, but understand that we are humans and we are biased. We might favor some sectors just simply due to our personality, or we might favor them simply because that's what everybody else is talking about right now, and we get in on the hype, which is all fine. But just understand that you will never arrive at an objective value because there is no such thing. And that is sort of the tricky part. Buffett and Munger, they usually talk about not doing a too advanced calculation and always make sure that they have enough margin of safety. So understand it's difficult to arrive at the objective value. So if you just have enough margin of safety, then even you're probably ballparking it quite good. So even if it's a bad guess, it could still end up being profitable just simply because you have so much margin of safety. And it's not about the outcome. So this is really important. A lot of analysts, they usually spend a lot of time analyzing the company, reading up on it, trying to figure out everything right here, right now, estimate the future value, and then they present it. Here's my analysis of this company. But the thing is, it's not about the outcome. It's more about the process. It's not about putting in the numbers into the Excel arc. It's about understanding what makes those numbers come true in the future. Why is the company on its mission? What is their mission? How are they going to produce those cash flows in the future? So the process is more important than just arriving at a good analysis, because everything is moving. Stock market is moving all the time. So it will be obsolete tomorrow because the market has increased or decreased already. And it's not necessarily better with more numbers. So the finance industry, it's really good at making things more complex than it has to be. So don't make it a black box. You don't have to use several different type of streams of cash flows and break it down into the smallest part of the company. So just make sure that you understand your number and where they come from. That's the main goal. Don't make it a black box, because then shitty inputs gives you a shitty result. And never a precise estimate of value. So we have to understand there is always uncertainty. So even if you understand discounted cash flow models perfectly, you will never have a precise estimate. There is no such thing as the precise intrinsic value of that company, even though that's what everybody's chasing, the intrinsic value. And if you could buy it at cheaper than the intrinsic value, but we will never figure out what the intrinsic value is, because it's in some way subjective, how people view the company, how investors view the company from time to time. So understand there's always going to be uncertainty. You just have to learn to deal with it. And it's not a timeless document. The best is if you could update it regularly, if you could have it as a sort of helper to understand what's the future cash flows, what's the goal for the company, how are they going to move towards that goal, are they moving in the right direction? So use it more as a guiding tool than a timeless document that you just publish and then it's done, because the market is moving all the time, and so does your analysis have to move along with it if it's going to be up to date. Here's some great books that have helped me a lot, and I know others investors as well. So obviously The Intelligent Investor, that is from Benjamin Graham, the father of fundamental analysis. That still holds really good examples. It's on some part a bit obsolete. It's more than 50-60 years, some of the content within it. I'd say the most important chapters, it's chapter 8 and 20. That's where you learn about both margin of safety and the Mr. Market analogy. And those hold very true today. And those are vital to understand. So chapter 8 and 20. And then the essay of Warren Buffett, that's the highlights from most of Warren Buffett's letters to shareholders in Berkshire Hathaway. There are so much insights from those letters. And you could obviously read all of them going back 50-60 years since they started Berkshire Hathaway or since they bought it. But these highlights, they serve really good. And the most important thing by Howard Marks, that's more to the soft values of investing. So always also building on your skill of understanding that value can come from softer values as well as the numbers. There's obviously a lot of other great books as well, but these are some really good books. There we go. That was my presentation. I know it's a bit longer than I usually expect, but nevertheless, we arrived here.